Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. Let's be real, it's not about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO at DealRoom and chief scientist at M&A Science. Joining me today is Larry Hartman, CEO of ZRG Partners, one of the fastest growing talent advisory and executive search firms in the industry. Under Larry's leadership, ZRG has expanded significantly through a combination of organic growth and strategic M&A, all while pioneering data-driven solutions for talent acquisition. Before ZRG, Larry co-founded Rockford Industries, where he scaled the company, took it public, and sold it to American Express. Today, we're diving into how to align M&A with a buyer-led framework, build scalable growth strategies, and create meaningful long-term value post-acquisition. Larry, how are you doing today?
I'm doing great. It's good to have you here.
Hey, thanks for hosting live in Manhattan, baby.
Yeah, this is where it's happening.
Absolutely.
Yeah.
Thanks for making the time. I appreciate it. I know we're both traveling around, and we made it happen.
Yeah, good to be together.
Can we kick things off a little bit about your background?
Yeah. So, my background is maybe a little bit unique. I'm a two-time entrepreneur. Started two businesses from scratch. You kind of alluded to it in the bio. My first business, I started right out of college in the financial service space, and one of those things you probably would tell someone never to do, start a business without knowing what you're doing, without any capital. But ended up that business, we grew, we got it to about 80 million in revenues 10 years later from startup. And then we had a dream to take it public. Back in those days, there was not a private equity market like there is today. So that was how you could get capital. So we did a NASDAQ offering. After that, scaled it to a couple $100 million and successfully sold it to American Express. That was chapter one of the story. So saw interesting capital formation and being bought and seeing, M&A from the version of the other side of the equation. And then, my current endeavors started ZRG 20 plus years ago. And again, startup business that has grown from zero to today. We're about 280 million, 650 employees around the world. We're in our second round of private equity, and it's been a lot of fun. We've grown organically, but we've also done, I think, now 17 acquisitions in the last 4 years. So we've been very active in the M&A markets. And so that's a bit about the professional side of what I've done for my lengthy career.
The first time is like you sort of hit the strides of the American dream, and that wasn't enough. You did a sequel to it.
Yeah, well, after I sold the first business, I retired for about 9 months. I golfed every day. I thought my handicap would get better. It didn't, and I had 3 kids at home, and my wife thought the idea of me retiring and golfing and her raising a family was not a good one, so I had to get back to work. It just wasn't going to work at that stage. So, it was nice to have a little break, but, it's fun to be in the action, fun to be growing things.
And so what I guess how do you do things different the second time around? I mean, did you do a lot of acquisitions on that first platform?
No, we didn't do any. I mean, the first platform was all 100% organic growth, all through hiring, all North America based. And then was acquired, and then as part of American Express, we did a couple of add-ons through American Express. But my first business, no. And in hindsight, I wish I would have. I wish I was smarter and wiser in that first round. But it would have accelerated growth, I think, in a bigger way. I mean, we should have.
Well, you went through the experience of an exit with American Express, which is another pretty monumental experience to go through. Has any of that experience sort of helped shape the approach that you take when you do acquisitions today?
Yeah, it helps us convince people to not be bought by a strategic, to be bought by an entrepreneurial-based organization. So we buy a lot of, call it, boutique professional service firms, whether they be exec search firms, consulting firms, interim firms. And the common denominator is usually a founder's, built it, got it to a certain point of scale, and wasn't sure what to do next, and they needed capital to grow, and so bringing them in, they are joining an entrepreneurial culture. So me knowing what it's like to be acquired has helped, and I always sell that. When American Express bought my first business, I knew pretty quick after that I had a job. I was a cog in a wheel and I had a job. When private equity buys your business, it doesn't feel that way at all. I mean, you now have rocket fuel to take the next steps, and you still have skin in the game because you're perpetually rolling equity. And they're always wanting to know you have financial skin in the game. So it keeps the adrenaline going. It keeps it, for I think entrepreneurial minded founders, it's a great way to take money off the table but still have that enthusiasm and growth.
Hey, can you teach me? So if I'm in looking at a target and it's competitive, and I got my big strategic competitor looking at the same target, how do I convince the seller to sell to me as the entrepreneur over the big strategic?
Well, I think there's a couple things I would jump to on that. So one is, if you're buying them, that's not the end of it, because they're rolling equity in you. And that equity in you is going to have a compounded effect that's going to have a lot greater outcome than joining some big place that maybe it's just a job with, with a bonus. So, I think what we sell, entrepreneurial businesses on, and, most deals we do have 25, 35% of the deal structure is stock. And we kind of say, if you took 100% of my stock and you didn't grow at all, because I'm growing over the next 5 years, you're going to get a 5x return on that stock. Like, it's the multiplication of, if you do nothing different and I grow, you benefit from that. Now, we don't expect them to do nothing, but we expect our growth to lift up their piece. So a strategic can't sell that vision. And so I think the financial side, you can come up with a pretty compelling case that by taking equity in something early on, the returns could be a lot bigger. And then the cultural aspect, entrepreneurs, if they haven't seen what big matrix organizations feel like, they need to understand what that's going to feel like, and versus working in a place, I think, like you would offer, where it's, more nimble and fun and enjoyable.
Okay, so we got two parts. There's the second bite of the apple, and then the culture piece.
Yeah.
Second bite of the apple is pretty straightforward. It's the financial picture.
Second or third bite of the apple.
Yeah,
I mean,
exactly.
no, it could roll. I mean, we're in our second round of private equity. We'll sell again in 12, 18 months. Yeah. I mean, it's that part. You're always there's always more, right? So
because some of the business I'm looking at, they're pretty stagnant.
Yeah,
so we're growing. So it's almost like, hey, you got a high chance of second bite of the apple.
Yeah.
Total picture is going to be growth, and we're trading at a high multiplier because we're in the high growth category. So I can see that being a favorable pitch, and I think rolling over the equity, there's some deferred tax benefits
for sure.
as well. The culture piece, let's talk more about that, because I guess how do I click in there so they really distinguish the difference? I get it. It's like you could go to a large corporate and you're going to get your title reduced and follow a bunch of bureaucracy. Yeah. How do I sell that there?
Well, I'm able to sell it because I firsthand experienced it, right? So it's, and so I can share my experience of what it's like. And it was great financially, right? But I had a job and I never wanted a job. I was an entrepreneur, and so I served out my time. And I knew at the end of my 3 years that was going to be the end of that chapter. With private equity, you get the same adrenaline every day to build something with the same rewards, but you're taking some risk off the table. I always tell the entrepreneurs that if you like being in the market and growing, we'll take HR, IT, accounting off the table for you, and we'll give you a chance to focus on the parts of the business you really like, and that's growth, innovation, whatever that might be that business brings to you. So I think they're selling the lifestyle, finding people that buy into that, and then it's finding people that don't want to just cash out and leave. I mean, if you want to cash out and leave, a strategic's probably the better bet. Right? I mean, if they're not hungry and they're tired at the end of their cycle, then probably not a deal you want to do.
FirmRoom, the world's most intuitive virtual data room, now with AI contract analysis. All right, at this point, I feel like everything in the world has AI in it. But let's talk about something important. Have you or your M&A team ever been blindsided by overcharges from one of those per-page billing virtual data rooms? It's 2025 and you'd think that scam would be extinct by now. If you're fed up with those outdated VDRs, check out FirmRoom. There's no hidden fees, none of that 6-month minimum crap and then the price doubles after that. Absolutely no nonsense. Best part is, You can check it out completely risk-free with a free 14-day trial, no credit card required. Visit FirmRoom.com and put it head-to-head with any VDR out there. Better tech for a better price. Here's to the deal.
So I got to ask, some of the deals I'm looking at are that person at the end of their career cycle where they're looking to be fully retired the next year or two.
Yeah.
You just stay away from those deals altogether?
Well, I mean, first thing I'm telling people is you should sell your business 5 years before you want to retire because I need you here. So, we're in a business that the people matter quite a bit. And so, we're not buying a revenue stream that exists outside of a founder typically. So
there might be a difference because I'm looking at software companies where they're sort of material to the operation and maybe the direction of the technology, but I can see us building a succession around that in the next year.
Yeah, and I think you can get a founder to stay longer than you think. They start always, when we get them, I want to leave in a year. It's like, well, for this structure, we're going to need you for 2 years, and we need another year as a senior advisor to the business, and structuring in such a way that they're going to be there to support the business, at least to take emails and calls that come in the latter parts, because they are rolling equity. They should have interest in it.
Yeah.
It also, the other benefit, it locks them out on a non-compete for a longer period. So I think, again, there's people that say they want to retire and then they get bored, and you don't want to have a competitor popping up in your space. So to me, the advantage, thinking about those founders, tie them in for a period of time. We always tag on a period of a senior advisor period and then a non-compete at the end of that, so that we're not running into somebody that we've made them rich and now they're taking market share from us 3 years later.
So keep them on for 1 to 2 years and then senior advisor for another year or two.
And then add the non-compete at the end of that.
And add the non-compete.
Yeah.
Okay. Yeah. That's fair enough.
Yeah.
When did M&A become part of your central strategy over at ZRG?
Yeah. So we did our first private equity raise 10 years ago. And again, then at that point we were small, $10 million revenue business, vision to grow. Brought in a firm called North Creek Mezzanine who brought in some debt and equity. I bought out a partner, and the vision was, invest to grow. We went from 10 million to 40 million, all organically hiring. So no M&A. We did one deal. We did one deal, which actually was a pretty good deal that we did. And then the second private equity sponsor, RFE Investments, their thesis was, you've done a good job growing, but we're going to want to put some gasoline on the fire, and we believe in M&A. And so we're going to want to take what you're doing and go harder and faster. And so, they came along and said, we're going to help you build the M&A engine. So it was, we need to find an M&A ready CFO. Eventually, we're going to build a corporate development team. So, they've been supportive of saying, if you're going to do 3 or 4 deals in a year, you're looking at 8 or 9 at any time. It's a real commitment of expense. So, so that's been the last 5 years with RFE. We've done 17 acquisitions, and but we built a machine that can handle it, and that's been part of their strategy. So I think it kind of depends on who your buyer is. If you're selling the private equity, what's their strategy, and where does M&A fit? So
we're getting interest from private equity firms, and it's. First, I used to blow them off.
Yeah.
Now I'm kind of like, I could see us wanting to incorporate M&A and that we should probably get a good partner. And I'm openly thinking here that if we found the right partner, we could probably grow twice as fast, get twice as far in the same period, looking at what's ahead in the next 5 years. So now it's taking the conversations and dating these PE firms. And what I'm realizing is they do have different capabilities and how they can support you. Some are more focused on organic growth. Some are more focused on acquisitions.
100% correct.
So now I've been trying to dig in and seeing like how well they can support those inorganic opportunities. Can you maybe tell me a little bit about your experience around that? Because you mentioned getting the CFO with M&A background, building out a corp dev team. How was that support? Because it sounds like you did the one deal before, but now
we did a deal or two, and then early on, we were doing deals with just myself and my controller, and their help. And it's like, no, we need to build a team that can support you. It's too much work, for the modeling and the different things we have to do. And so they were just supportive of let's go do a search for a CFO with deep M&A experience, and then building on top of that. It was a year later that CFO had enough on his plate that we needed to have a head of corp dev to do all the financial modeling of all the deals coming in. So again, when did a search, brought in a corp dev guy who got a support person. So I think it was their commitment to being willing to hire the team to support what we needed. So I think when they say we want to do M&A, if I'm in your shoes, I would say that's great. We're going to need to make sure we bring in an experienced CFO, and if it ends up being a big part of our strategy, having an internal team, or there are ways to do it with external partners. We still use partners. We certainly use accounting firms for due diligence, and and law firms for legal diligence, and market research firms for studies sometimes. But we're driving to the work to get to that point on serious deals.
So they help you recruit the team to scale M&A as your capability in the company. Is there anything else they help to dial it in terms of helping you get better at doing deals?
For sure. To me, the advantage we've had with private equity is that I haven't had to think about capital. So we've been through a couple different cycles. So our firm invested. We brought in a secondary private equity firm. I think 2 years ago, we did a continuation fund. We brought in Timber Bay Capital, who brought in a significant amount of additional capital. And then, most recently, our bank, maybe a year ago, felt like, okay, banks in the U.S. were a bit, not very friendly in terms of lending. And they're like, we think you've probably done enough for this year. And our PE firm was like, no, we're going to do more. Let's go do a private credit raise. So they drove the process to bring in a banker. We did a private credit fundraise, and we ended up getting 4 offers. We raised $120 million with Main Street Capital for growth in M&A. So I'd say for me, they've had the direction of like, where do we go next to keep the the fuel going for M&A. So I think if that's, to me, as you say, support from a private equity firm. They've been very proactive at making sure that we had the checkbook to be able to buy the assets that we wanted to buy.
Going back to the retaining founders post-acquisition, what are like specific structures? Because you mentioned giving them some rollover equity, 25, 30%. Is there anything else that really incentivizes a founder to stick around and be committed to growing together?
Well, sure. The deals, almost every deal we've done has cash. It has stock as an earnout. Earnouts are typically 3 or 4 years. They're based on growing from a baseline number, so that helps. We use employment contracts to lock people in. And there are times when we have really important founders we need to make sure they don't decide they want to retire, that we will actually put in penalty clauses into the employment contracts, that if they were to leave before, that they're indemnifying us from any decline in business. So like they literally can't leave. Like there are times we're saying, no, we're going to make sure you're here. You're committed to the 4-year term, and you can't get tired in 2 years, decide you want to retire, because I'm buying you based on you being here for the 4 years. So we've been sometimes pretty prescriptive in terms in employment contracts when a founder is critical, where if they were to leave, they can't really leave without a financial penalty or giving back proceeds or doing some things. So each deal is a little bit different, but
I was going to say, what's that structure? Do you have both the earnout and then rollover equity and
penalty clauses sometimes?
And some penalty clauses too.
Yeah, we call it. We don't call it that when we're talking to the founders, but it may be that sometimes it's specific clawbacks of cash on a pro rata basis if they leave before the end. Other times we've used indemnification language that should you leave and the business suffer, that the valuation change from you leaving, you're indemnifying us from that. So when we've had it where a founder says, I think I want to leave, it's like that could get costly. It's like, do you understand? Right. If you leave and the business drops, I bought the business based on you being here. And that wasn't part of the deal. So, I think that's been, for us, locking in founders on professional service firms that are relying on people is pretty important. And so we've, we paid a lot of attention to it.
What does that structure end up? Because can you have like 30% in an earnout, 30% in rollover equity, 40% cash, or is it different?
Yeah, it varies. We've done them from 50, 25, 25. Sometimes we've done more cash. Sometimes during the pandemic, I think back to one of the really interesting deals we did. We bought a sports recruiting business called Turnkey. Turnkey had a a really cool business that did professional sports recruiting. And it was 3 months after the pandemic, and nobody was in. If you remember that time, there was nobody in sports arenas. There was nothing on TV. And so they were pretty concerned, like, what's the future hold? How long does this last? And so we felt sports was probably not going away. Not that difficult to leap to guess that. But we bought that business, and we did, I think, that deal 70% stock. We were at a point where we were a little bit, being conservative ourselves, it still was an uncertain time, but we did a heavy stock deal. Now that business has since quadrupled. We're the number one player in sports recruiting right now in the pro and the college ranks. It's a global business now, but we were conservative. He took a gamble. He'll be one of the biggest recipients in our next recap of proceeds because he took that risk. But, so I think it'll range on timing, circumstances, risk.
It's an interesting deal because it's one, you're looking very long term.
Yeah.
And everything was chaos at the time, near term. And you're right, like nothing's happening, no events are happening.
No, it could have been a year, 18 months. I mean, who knew, right? I mean, if you go back to that time, it was. Well, I mean,
was it like the terms were too good to make it, forego, or it's like, they're in trouble, like we're gonna.
No, it wasn't. So I think that he'd been through a few cycles and was tired of the cycles and felt like, again, the reasons to join our platform, he wanted to do more, but was tired of putting his own cash into growth. And so, it's great. I mean, that business, literally, we've quadrupled in 5 years. What he wanted to accomplish, Len, the founder, was to grow the business, make it global. We built out Europe. We built out Asia. We added college sports on top of the work he does in pro sports. So, like, for him, what he wanted to accomplish, we were willing to invest in.
So you supported it with the capital to help him execute this plan. He had rollover equity,
and he's got and that one again. We wouldn't want to do a deal with 70% equity now. Like now, our private equity group would say 25, 35% max because it is dilutive to us. We'd rather give cash. In those days, it was kind of like, let's hold on to cash because we don't know how long it's going to be till companies are back in an aggressive hiring moment, and it ended up coming back pretty quick. So we benefited. It swung back 3-4 months after that into a pretty good market. So.
That's we got that saying, buyer-led M&A. You don't do M&A on impulse.
Yeah.
How do you sort of build that view between kind of your short-term investment versus the long-term view?
Well, I'd say a lot of it comes down the pipeline. I mean, I can't tell you how many deals we've done that a year or two before we made an offer, and they weren't educated on value. They weren't ready. They thought it was too low. So we let them go out and do their thing, explore. They come back a year later and they saw we were reasonable, we were good guys, and we ended up getting the deal done. So I think it's patience, staying committed to how you want to structure deals and do deals. We lose a lot of deals at the offer stage, and we're good with that. It's part of the process. So I always tell when my business leaders come in from my sectors, they're like, they fall in love with the deal. I say, don't fall in love with any deal. You don't know which one's going to happen. You don't know what founder's going to be reasonable. You don't know what lawyer's going to, complicated deal. So I think it's just taking the long-term approach. If I'm making an offer for a deal today and they don't like it, I may get them in 12 or 24 months, and that's happened multiple times, where just the timing changes and they, are at a spot where they realize we're a real good option.
You got to have patience.
Yeah.
What's your approach to building relationships with these founders? Because you get proprietary deals where you're doing this over time. You're building a relationship and you're sort of hinting or courting, and I definitely want your perspective on it. And then you get the others that are going through a process. They retain an advisor and they're setting stage gates and trying to get something done in like a month. Can you walk me through your sort of philosophy and how do you leverage? Because the better the relationship you have, the better the deal is going to go, in my opinion.
Yeah, I mean, we've had less success on deals in a process. I mean, we don't get excited about a banker sending us something. We get excited about finding our own transaction flow and creating opportunities. So, because you can build a relationship, and they do value the time you spend to get to know them, to get to a point where something makes sense. So, I think either way, I mean, and we've done a couple where it's been a process, but we'll insist on, time with management, time with CEOs, so that there's a relational aspect to the decision. And I always, I tell the story to potential acquisitions that, when our last private equity firm invested, the multiple they invested at was not the highest of any of the firms we had, but they were a friendly firm who'd been around 30 years, who I knew their strategy aligned, who wasn't going to make my life miserable. And I'll reiterate, like, you don't want to sell for the last half a turn of a multiple because you're going to have to live with this. You want to sell in a spot where you're going to enjoy yourself, where the strategy aligns, and you'll end up making a lot more money in the long run because of that. So, I think it's having those kind of conversations where, a person who's selling you their business thinks it's their one time and they've got to get the last dollar. And I just say, I've been through it. That's not what it's about.
Right.
It's whether you get 94% of something somewhere else, but it's a better environment, you enjoy yourself, you'll be way ahead. So find the right cultural fit, find the relation. So I think it's educating and talking that way. And if someone doesn't value those things, if it's a pure financial play, there's probably someone who's going to outbid you and outbid me, right? I mean, that's
where I get a little struggle with it because I got a couple. I got one deal, it's direct proprietary, no banker. The other one's got an advisor on it. And you can tell they're kind of sitting in the middle. They kind of pull the founder off the email chain, and want you to communicate everything through them. Where the other person, you're grabbing the cell phone, you're talking through something they didn't like an NDA, you pick it up and just start handle it instantly. So it's in some ways I feel like it slows down or thwarts that relationship development.
But that gets down to your M&A machine. Like, how are you creating opportunities, right? So, that we have a pretty fixed process in ways we get, pipeline. I've got 10, 12 deals in my pipeline right now, and some come from, we have an internal team that does recruiting that finds deals. We have one buy-side banker that's bringing us deals. They're calling companies, finding deals. I speak at industry conferences and talk about M&A, and people know we're in the business and reach out directly. So, like, if I look at the deals that are on my backlog right now, probably 1 out of 8 is from a banker to us versus us initiating and finding the opportunity. And so it's possible. It's
being
long
proactive.
term. It's dedicating time to it. It's spending time meeting companies ahead of when they're thinking about wanting to sell, them knowing your story. So I mean, I guess that's the advantage or disadvantage. I've been doing this for 20 plus years. Is I've been always thinking about the meetings I have today may not pay a dividend today, but they could in 2, 3, 4 years. So I've got to build long-term pipeline.
That's true. Do you convince people to sell?
Do I convince them to sell?
Yeah.
I think there's got to be a driving reason within them that they want to consider it. Now, I'll ask people sometimes, like, hey, what's your plans with the business? Like, what are you going to do? Are you going to hand it off to your kids? Are you going to retire? Or, like, what are you doing? And sometimes they haven't thought about it. And so I think engaging a firm to a founder, like, what are you thinking? If they haven't thought about it, I'm getting them to think about it,
Right,
and then I'll go down the road of, listen, my advice to you is if you're going to sell it, you should sell it 5 years before you want to be done. And that's usually that day. Usually when I'm talking to somebody, they're not 20 years away from wanting to retire. They're not loving what they do every day. They've been doing it for a while. They have something happening that they know, that they've got to think about a transition, whether it's, can I sell it? We get a lot where they think about selling it to the existing team that's there. And, I want to maybe turn it over to my employees. And we'll educate them on the math and challenges of how that generally doesn't work and how it's not better for them, and how, we've got lots of stories of, employee purchase businesses that end up just handing it back to the old founder because they don't want to pay the notes. And, so it's that's the discussions 2-3 years before they want to sell. And then when they do, they remember the fact you were thoughtful helping them think about it. So.
And then, you can still, if you have key people, you can still incentivize them. You can still provide some equity type of options and things.
Absolutely.
Is that part of it? When you're talking to these founders, you're inquiring about what their exit or sort of what the plans are for the business, and then saying, hey, you kind of bring up, like, thinking about exit 5 years ahead. And then your M&A program, the rollover equity, seems like a big upside. Are you bringing that stuff up in those conversations as well, or do you wait till later when they've expressed interest to sell the business?
No, I think it's, once we present a structure, we'll show them the math and we'll lay it out very clearly over 5 years, how it all works, what the upside could be, what their earnings will be during that period. But I think you bring up another point, like there is also, how do you incent the non-founders? Because there is often, we're looking at a deal right now where the two founders probably could retire. They've handed off most of the business to 4 other folks in the business. We have to lock in the 4 people who aren't equity holders. So I was just going through the structure of what we're going to do on that, and that one is, we've got to have part of the earnout shared with the non-owner group. We've got to make sure those 4 other people are locked into 4-year contracts. We got to make sure they buy in, or we're not doing the deal. So, we had another one we just closed with it was a spinoff from another private equity firm. They had bought a legal recruiting business, and it was part of a bigger legal services firm, and they weren't paying attention to the recruiting side, and they wanted to sell it. Well, the team that worked there for 10 years had no equity. So now if I buy it, I'm paying the parent company for the business. Well, that's a risk, because now you've got a business you bought with employees that aren't incentive at all. So we approached that one where almost 40% of the proceeds would go to the management team that was there. And we told the parent, listen, we'll buy your business, but I can't buy your business and those people leave. So if you want to sell it, we're going to have a significant amount of proceeds that are going to get paid to the team that stays. At first it's like, well, but we've created the business. It's like, yeah, but to sell it, you can't sell it without those people going along. So, it ended up being a successful deal that we did. The management team was thrilled because they went from no incentive into a pretty significant incentive in that case. So, there's that thinking about who are your key people and how do you lock them down. It's not always the selling shareholder. So,
okay, I'm gonna throw another question at you around this. Because there's you got a proprietary deal, you got control of building a relationship. I've had another deal where I reached out, but then all of a sudden it's like an advisor. Hey, I've already got this advisor retained, and they're the ones that come back and reach out. And what I'm realizing is that there's a number of meetings that you have that gives you more certainty.
Yeah.
And then this is where I want to tie in the culture piece to it, because the better I understand the culture, the better I understand I have certainty that post-close this is going to work out. And I'm just curious on just your advice. Like, is there a certain number of meetings or just certain things that you really want to get get that level of certainty? And then, what do I do in the advisor situation? Do I sort of demand to have that same level of engagement?
Yeah, so I'd say on the advisor side, you need to be friendly and engaging with the advisor, or they can steer a deal away from you. Right. So if they see, hey, you're difficult, you're not high probability of closing, they're gonna push that seller to someone who is high probability of closing. So I'll start with the advisor. There's a separate sale to make to the advisor that you have capital, you're serious. I always tell the advisors, we've had 100% of letter of intents have ended up in closed deals, and we've never repriced a deal. Like that's what they want to hear. Like they don't want to hear, you're throwing out terms and you don't close things, or by the time you get to the end, it's going to be different. And these are true facts in the deals we've done. So I think I have this process to make sure the advisor knows we're real, we have capital, and we're good guys to work with, right? Now you shift the other side, you got to spend time with the company. And we do that in a couple different ways. It'll be the social setting. Let me get to know you. Tell me about the business. Then we dig in and do the diligence. But often, and we're doing this right now, before we make an offer, we'll have a session where we want to sit down and talk about the next 5-year plan. And we're doing this, I'm 2 deals right now where before we've got the numbers, we know what we want to offer, but we got to get that owner engaged in helping us think about what are the growth drivers on their side. And as part of the fun discussion, they get excited about it. They get lit up about, oh my goodness, I've always wanted to expand into this. I always wanted to have investment into that. I've never been able to do that. So I find that session to sit down and say, hey, before we can finalize an offer, let's spend some real time thinking about the synergies, what we could do, and let's create a framework for a plan. Now, that does 2 things. It creates the working rapport that you need. It creates kind of the framework of a deal, but it also creates what you're going to tie back to some incentives that they've been a part of. So if you throw some numbers at them and say, hey, if you do X, I'm going to pay you Y, it's less impactful than like, hey, we came up with this 5-year plan, and it's pretty ambitious, but if you hit 80% of that 5-year plan, you're going to get a great, extra super earnout on this deal. And we've done that where we'll have a standard structure, and if they hit a real big number, we'll say, no, there's a super earnout. Well, what's a super earnout? Well, okay, hit that really big growth number, we'll pay you even more for it. And it's the process of engagement that through that I think is how you build trust and you build kind of a business chemistry with a firm. And even with an advisor, they may sit in on that session, but they're not going to be adding much value to you having a strategic business discussion about growth. So
you're really thinking through 5-year plan. Where do they see? What are some of these things that you may be able to enable them to be able to do?
Because other firms cut that short. They don't spend time on that. And so you can think about
you got your diligence checklist, Larry. Yeah. That's why. You want to sit there and check boxes off of.
That doesn't make someone want to work with you, right? That's just but a vision of a dream of building something with a business. And that's the sports business I told you about. When I sat with Len, and I remember it was during pandemic, and we met at my house because you couldn't meet in person anywhere, but we met on my deck. Yeah. He said, what is it you want to do, Len? He says, I want to have the biggest sports recruiting business in the world. I said, well, what does that look like? He goes, well, Korn Ferry today has the biggest one. It's $9 million a year that they do in this sector. I said, okay, well, what do we need to do that? And it's like, we need to build college sports. We need to build Europe. I said, okay, let's build a plan out. And we built out the vision. He got excited about the vision. I said, I'll fund that vision. We're going to do that. It'll take us time, but we've executed 100% on that vision. Talked to Len today. It's like everything you said. I said, it's what you said. I just pulled out what you wanted to do, and we built that plan, and it's been successful. So he bought the dream, and the dream ended up being something I could back and grow. So
there's 2 different hats. There's minimize risk, and then that's one hat, and then there's maximize value. That's another hat.
And there's selling rapport, and there's getting them to want to work with you.
That's still maximize value. That's like part of it, right?
Yeah,
it's like because it is like, hey, I'm sharing the same vision. Like you're sharing your vision with me. Yeah. And now it's becoming our vision. Yeah. And I think that lends to, and I think you're right that it does get cut short because when you think about due diligence, it's not maximize value. No. So I guess one is like, how do you strike that right balance? Because I'm doing it right now. I'm looking at a deal, and I'm literally only thinking about minimizing risk.
Diligence, for us, we're fortunate. Diligence is done by a Q of E with an outside firm and a law firm. That's just diligence. That's check the box. What are the financials? What does it say? Legal. That's a check the box. But the rapport building and the building the plan together, that's high value work to get to a deal that would want to work with you at a price that may be less than someone else, but it also sets the table for hitting the ground running to have a successful deal. And it gets into like, what is it we're going to do after we're together? To me, that part about, you could buy something and in 6 months you don't agree on direction, and that's the wrong time to have that discussion. It's not going to work. So to me, that part about saying, hey, let's agree on what it is we're going to do, how we want to do it. And, some stuff's certainly contingent on hitting thresholds and margins and, all that kind of stuff. But it creates a better working relationship too.
I think it's a strong point here is to really put as much emphasis on maximize value. So referencing buyer-led M&A as the framework, a key component of it is just early integration planning at the end of the day, that you should be doing it in parallel, which seems like it's what you described. It's almost getting that alignment. Can you tell me a little bit more? Is there anything that you do specifically to connect diligence or even diligence findings with like your integration or just integration planning in general?
I think we have a plan for every acquisition. Each one's a little bit different in terms of what we want to do, based upon, how fast we want to grow and expand. But, I think in our world, and again, these are people businesses. We have a mantra that we tell, the companies that first thing is do no harm. We're buying you for what you are, right? Then we're going to bring you the good things about being part of our platform. So we bring good things. We give them a global footprint when they might be regional. We give them technology they didn't have that, as a small firm they didn't get. We take off the things they don't generally like. Right? We're going to take off HR, IT, and accounting. We can do that for you. So, but then over time we start to integrate in a deeper way. So our thing is, on integration is lay out, with them how, what's it going to feel like, but don't disrupt them too early in the first 3 to 6 months. You can get overwhelmed with change and let them continue doing what they're supposed to do. So we've taken our time on it. And sometimes, it's a year process to really get them into the fold where they're on the same CRM systems, we connecting all that up, but we'd rather get the financial performance than perfect integration. We can figure out, the accounting integration, being perfect later, or the IT integration. So, to us, it's numbers first and culture and clients. Don't screw up what they have with their clients, with the culture, and take your time on the other things. Because it's catastrophic if you screw up a deal, right? I mean,
don't piss people off.
Yeah.
How and when do you communicate this? Like, hey, there are going to be some big changes that we do after close, because I feel like this is where things go awry. People get blindsided by it, then people get pissed off. Versus, do you just communicate this early up front? Like,
we'll talk. I mean, that may be in the third or fourth meeting. We're talking about the business plan
still
moving forward. Yeah, before. Yeah, or maybe part of it. But I mean, in our world, they know, that it's do no harm, bring the good things, and then integrate. I mean, that's kind of the playbook of how we describe it, and that's how we live with that. Now it may be a 12-month process. Sometimes it's been a 2-year process to get from doing no harm, good things, part of the firm. So I think it's understanding the business. Some have deep brands, deep customers with, for us, contracts that are complicated. We bought a business in the higher ed space that had been around 40 years. They had, contracts with universities that are tough to get, MSAs, to switch over to another firm. So we didn't want to disrupt contracts. We wanted to keep things rolling. So, that one may take 3 years to fully integrate the contract side, the billing side, but that just, we can make that work. Internally, it's more work for us, but externally, the clients don't feel any different.
Does it end up like different? I'm assuming most of your deals are like asset deals. Does it end up being like a stock deal then later on?
We've had to do a few stock deals. And we always try to do asset deals, but there are more stock deals than we probably care to admit.
But like that example, when there's like this sort of long MSA in there, does that end up being more of a stock deal?
Yeah.
And you gotta,
because there is value in the in the value of the contracts and what they have in that side of the business, for sure. So but we luckily we've had flexibility to do both, both stock or asset deals. So
I'll let the lawyer get into the weeds in that in the next interview. Okay, so this is good in terms of getting the integration. A lot of it's communicating it early, just setting those expectations. The big bid-ask spread. It's one I'm curious about, and I'm noticing it. I'm sure you run across that. I know we're different industries, but especially in software, people see with the VCs are investing in 10, 20x revenue.
Yeah.
And then their expectations are so high. How do you manage that? Because a lot of the companies I'm looking at, it's like you're not in triple digit growth. You're pretty stagnant growth. So,
and they have a misaligned view of their value because of what they hear.
Yeah, exactly. And I'm just curious, like if you encountered that, how do you sort of get that rationalized?
Yeah, I mean, so we're in a world. The multiples are not that. I wish they were. We're trading at, companies in the 5 to 7 times EBIT number. Nothing to do with revenues. Yeah. It's EBIT. So it's low multiple. We create value through lots of earnings. But that being said, especially when we're doing proprietary deals, the people have a misinformed view of what their value is. And so what we'll do sometimes, we pull out public company comps. In our world, good or bad, our public company comps are Korn Ferry, Heidrick & Struggles, who don't trade at great multiples in general. So we'll educate them and look at the public company comps in our market of what things are trading at, give them an indication where we are, and explain to them, we have to have some arbitrage between what we trade at and what you trade at, and this is what the market is. So, if we're trading at a, 6 or 7, we'll buy something at a 4 or 5. But there are deals that when we tell them that, they go away, and a year later they come back, sobered up and realizing nobody's paying 2 times revenues for their business that is worth 40% of that. And, the first time when buyers see a price and it's proprietary deal stuff, 50% of the deals blow up at that point because they're just unrealistic.
And you're at a point you don't have deals. It's like you're pretty programmatic about how you...
Oh, sometimes we get the price quick just to screen it.
Yeah.
We'll get to we need to give you an idea of what this would look like, and we'll refine it through diligence, but here's how we're thinking about it, because they'll say, sometimes we'll get clues that they're unrealistic. they'll say things about value, and it's like, well, we need to make sure they understand the market or go get educated about the market. And we're competitive in our space on buying businesses. We're not going to, be the highest, but we're the most active in our space of anyone. So, we've got some credibility to tell them, hey, no one's buying more than we are, and this is what the market is. But
there's comps. There's the second bite of the apple.
Yeah.
It could be like, hey, you know what? We're going to share this upside because whatever we get valued at next, you're going to get a good chunk of that in your value. And I'm like looking at the situation when you have a proprietary deal. I think it's one thing dealing with the founder directly to try to get realistic expectations on value. Then the advisor is another one, and maybe they're not running a full auction process, but they're running that kind of targeted type of approach. And some of it's almost like they're fielding out bids, and you almost feel like you're bidding against yourself if you put something out there. And I don't know if you found like a way to sort of, just, you don't want to just be thrown, because they almost like are creating a little bit of this distance where you're not having that table seat conversation, or maybe you should. Maybe I should be at the table with the founder to start presenting the terms.
My gut is you're going to have a hard time competing in auction. I mean, it's just tough. If they're out really going to 100 companies, they'll find somebody that wants to buy that software company at a price that's probably, a stretch. So
and they tell you they don't. They tell you like, oh, we just got a few companies looking at this. And I'm just like,
I think it's finding a sweet spot where you can do something other people can't. So now for us, we've bought a lot of businesses, call it $10 to $30 million in revenues as add-ons to our platform. That's too small for our public company comps, for Korn Ferry and Heydrich to want to buy them. That's like not worth their time. And it's too big for the boutiques who don't have capital to buy them. So like we've figured out a little bit of a sweet spot of like, hey, if it's a deal in this size, we can be competitive. If I get a banker calling me on a $50, $100 million deal and they're shopping it, I know I'm not going to waste my time. They're going to go out to everywhere. It's going to be price sensitive. It's not about there's a point where it's not about relationship, where it's going to be about price. And so I think there's that. If I'm in your shoes, it's okay. Where could you find deals that are not going to be as obvious to everyone else, but they're great for you? That you could find a little bit of a competitive advantage to win those deals or create those deals. So I wouldn't want to be competing against other software companies that are 10 times your size with a better multiple.
Right, I agree. That's where I'm looking at these smaller, like 3 to 5 million revenue companies.
Yeah,
that's a
good size.
Yeah, there's not a lot of others that look at it.
Yeah, it's too small for them to hurt their head, and
especially if they're stagnant. If they're stagnant, then. And you got a founder that wants to leave. Yeah, all those sort of things becomes less attractive.
Yeah, you'll find your sweet spot. I think that to me is what you do. Is you kind of come up with the box of what is it that you can do that's attractive, that falls in a range that's not going to be 10 firms bidding on it, that you waste your time, because you can waste a lot of your time on the wrong deals. I'm big about not wasting my time on a deal that has no probability of closing. And I can sense that. I mean, I guess just with age, you get a sense of that. But, but from an initial conversation or two, I get a feel whether, okay, this is a deal I should spend time on.
You ever bought a deal out of the chaos?
In terms of turmoil and a
turmoil, stuff going on, maybe just some real issues are going on, and you gotta roll your sleeves up and do some fixing up.
I think it's funny because our private equity group likes the idea of broken toys, buying things that used to be profitable that aren't now, and I'm like, I don't want to fix it, so I don't. There is a philosophy of doing that. It's tricky. No, we've kind of tended to find, again, our sweet spot is, it's profitable. It's got a certain revenue size. They want to stay. Like I think as we talk about, I'm probably pretty clear about what really fits, and then the other stuff on the fringe, it's like, no, we're not doing that. We pass on a lot of deals that lots of revenue, no income, and it's like, yeah, but if we did this or did that or you owned us, we'd make money. It's like, no, we're not going to gamble on that.
I don't know if it's me just having the Indian blood. Like I'm opportunistic. I'm always looking for a deal.
There is a way to do those deals. I mean, we've done one that way where we bought the business on future EBITDA only. So we'll buy you, and you show me you're going to be profitable. So I'm going to buy you off what your profits are at the second year. I'll give you the formula, because they'll say, well, I'll wait till I'm profitable. It's like, no, I'll buy you now. You tell me you're going to make $2 million in 2 years, I'll pay you 4 times that number in 2 years. That's the earnout. And I'll help you get there. So it's better risk than you doing it on your own. So I'll pay you nothing now, but I'll pay you in 2 years on the earnings you generate, and I'll take some risk off. You don't have to worry about IT and then accounting.
How do you keep from weird things happening where they like fire everybody in the second year just to get
then you just have some, you got to feel good about the people and the reason. Yeah, I mean, I think that's something. The broken toy thing is tricky, and there are certainly firms that make a living finding challenging things, stripping costs out, figuring out how to make them profitable. We've just gone a different direction.
How do you think through strategy? I think one of the things is I'm looking at these opportunities. They're like very obvious. They're stuff directly in our space, which overlaps in capability. And I'm just wondering if we should be more strategic, looking at the broader universe and adjacencies that would be more cross-sell opportunities as opposed to, very similar types of assets.
Yeah, I mean, I'll give you the parallel to what we did. So, we're started off exec search firm, first private equity investment. We went from 10 to 40 million as an exec search firm. Then it was our clients have more needs than pure exec search. They have interim needs. They have consulting needs. They have RPO scale-up needs. Let's take advantage of the fact that we're having conversations with CEOs, boards, and we can address those needs. And so to us, this last 4 years, we've been diversifying. That's been part of the strategy. But I think there's that. Do you have some scale to fuel cross-sell? I mean, we had scale. We had 100 managing directors on the search side who were finding opportunities. Which, when we started getting in the interim space, half their business came from the search side of our business. So, I think it's definitely there's adjacencies that can make sense, but it's. In the early days, if it's a small piece and you're a smaller piece, is it really going to fuel? Is any part going to fuel the other, right? Or are you better off pouring into your core business, and then when it's larger, look at the diversification a little bit more. I don't know. So
obviously the strategy will evolve as you grow, but in this early stage, and maybe it's just valuation arbitrage is basically what I'm bidding on, is at least get big enough where over 20 million revenue opens up to a different pool of investors and different valuation multiplier. Yeah.
Well, you're in a good spot where you're valued on revenues at high numbers. So it's, it is worth some gambling for sure. To find, if you can find how to aggregate, to get to the size and scale where you're going to get the better multiple. So you just, again, got to be careful that you don't buy and then it disintegrates in 3 years and you're at 50% of the revenue level you bought it at.
No, that's why you want the steady revenue stream.
Yeah.
Finding the right private equity partner.
Yeah.
Dating. Teach me. Now I'm starting to take it serious. But in the beginning, I had a little ego, and it's like, we're doing well. Like when I wanted the money, you didn't want to give it to me. Now I don't need the money, and you want to give it to me. But now it's like, there's some good private equity firms out there. They're not all bad ones. There's some bad ones, but they're not all bad. There's some actually really good ones where I'm impressed. I've had them on the podcast. You're just highly sophisticated investors that I could see. I would love to work with some of these people. They would teach me some things. They would challenge me. They would help me grow professionally. How do I go about finding them and making sure that, those first few dates, you don't sort of jump into the marriage too fast and find out you got to get a divorce?
Yeah. So, and I would say, my first private equity raise, I did the fundraise myself. I'd say it's probably a mistake. We were 10 million in revenues. We went to kind of the mezz finance world and, reached out to a bunch of people and had a bunch of meetings. It would have been better if I had someone representing us. The second process, we had a banker that went broader. But at the end of that process, it was finding someone that aligned on the strategy. So I think there was that time to say, let's, same thing you talk about doing with someone you're buying. Does that PE firm strategy and belief in what you're doing, are you aligning on that? Are they the kind of firm that puts an operating partner next to you? Are they the kind of firm that's hands off? Are they a patient investor? So I think there's that element, that we were fortunate that we did a lot of recruiting for private equity firms already for portfolio companies. So my team could tell me who fired their CEOs that I didn't want to bring on that would get rid of me. It's like, let's bring a new CEO in who sticks with management, who's patient, who decides they want to change things out. So there's different. I mean, there are thematic approaches PE firms have, of how they deal with founders, management, patience, downturns, and it comes out through the history of looking at other portfolio companies. So I think there's, my advice to you would be, if you're going to go raise capital, go do a process and go. It's a lot of time. But go through a process, get term sheets, and get to know a few, and pick the best one. This is a good time if you have a good business. PE is always looking for great investments, and then the diligence is probably around past portfolio company CEOs that have exited and are in place, and and talk to them and what they're like.
Reputation, I agree. I'm starting to feel that out, where I talk to good folks I know and I ask them.
Yeah.
And I'm getting a sense of that, which I think is important. Like, it's just like you get a good referral to a lawyer or any other provider. It's meaningful. Running the process is interesting. I guess one thing I was thinking about was, it seems like when you're over 20 million revenue, it opens up your horizons to more of these sophisticated, a little more sophisticated. Because I feel like when you're small, you have everybody reaching out. Yeah. Good old search funds. And just random people.
Well, and some don't have money and they want to take your deal and go find money. That to me is always, you can waste your time on something that happens.
So I'm wondering if, hey, can I sort of lock in an opportunity, a couple, one or two of these targets, and then use like a post-acquisition pro forma to, maybe I'm getting a little ahead of myself here, sort of use that to kind of say, hey, here we're going to put this company and maybe this other company together, get us about the 20 million revenue, and then share.
Oh, that's it. Yeah, no, that's absolutely a strategy. And you could, that to me is, if you found a bigger deal that was more expensive than you wanted to do, let's say it's equal size to you, right? And say, listen, I'm in the process of raising capital. Here's what I think we can do. I'll pay you X multiple around closing a deal, and you and I will be part of closing the deal together. And I think you come to that private equity firm and say, I've got growth plans, but I've got a deal right now that'll close as part of the deal. They love that.
So then you could get that valued on a sort of a post-acquisition
you're going to get some arbitrage on it. You're going to get the scale of a bigger company. And when we go to our processes, and we'll be in the market again in 9, 12, 18 months, some period for our next private equity investor, I want to have a $50 million deal sitting there for that next investor, but bigger than what we would have done. And it's probably not a deal I would do today, but it's a deal I would do with that next investor who's got a bigger appetite. And it'll be sitting there ready to close. And I can go to that company I want to buy and say, hey, I could pay you a little premium on the multiple. You're going to be part of my process. And I've already started those conversations now with people that I know actually are a little bit bigger than I want to buy today, and just saying, hey, if you want to do something end of the year, I'm going to be in process. And I think it might align really well with your size and what you think your value is. So, it's absolutely put a deal together with a deal is a great strategy. So PE loves it.
Okay. That's actually good to hear. So that way I get upside of sort of a target valuation of where I wanted to be at around the 20 million mark. And then
no risk unless the deal closes. Like, it's kind of an if-then deal. Like,
and then there's still going to be dry powder. Based on the terms that we'll continue doing more deals. Yeah. And then it should be a good win-win. What do I need to do to pitch that? Do I need to just kind of come up with a pro forma? It's like, what should I be doing to pitch that kind of
scenario? So I think certainly you need your 5-year plan and what it looks like, and then you got to be able to go and
5 years out. Okay.
I would think so. So I'm always thinking, a vision. Again, it's always, the first 2-3 years are pretty much a plan, but then there's a vision of what you want to build. And then I think because you've got to sell that vision to the next, to the guy you want to buy. And then, finding that deal to say, hey, I'm going to be in the market. Are you interested in being part of a private equity transaction? I think we could do this together, and here's how I would think about value, and it'd be part of us, getting this done on a deal. And you can go pitch that to. I would save that for a deal you think is too big for you to do alone today, or that maybe is a stretch on price. That. You say, I wouldn't take that risk, but on a deal where I've got more scale, I would do it.
How about let's talk about wealth preservation. So, because that's a big question. I'm in a fortunate spot where I bootstrapped everything to this point. I got an option pool to take care of the team members in the company, and we're growing well. We're in the 40+% year-over-year growth, and I have confidence we'll maintain that for the next few years. So part of me, when I look at this, the capital, it's like, well, I don't really want to dilute the equity right now for the organic stuff because we don't really need it. We got good cash reserves and we're growing nicely. But the acquisition makes it interesting. But then you're like, well, can I leverage as much private credit as possible, or even better, have the seller do an earnout, hold some paper, get them to take some of the risk. And then there is like, maybe you get the right private equity partner that's going to bring this level of sophistication where I don't have to overthink this capital structure like you described.
I mean, that to me sounds like your dream, right? I mean, and again, most private equity company will look and say, hey, if we're buying you, can we put 4 turns of debt on you? And they're going to go get a debt commitment ahead of time. So they're going to, and we did that. It was initially with a bank, but the banks, just grew conservative. And so they reached out and made it a private, private credit transaction. So part of that private equity firm is going to be, they're going to put debt on you anyway. And how much of that's going to be dry powder you can draw down on. And hopefully you have both equity and debt to be able to grow with. Which, we're fortunate to have both,
it makes sense to have both because they're going to get better terms on the debt. That's what I'm realizing.
Yeah.
The bootstrap company, the banks are not friendly to it.
No, when you're private equity backed, there are lenders that will lend to you. Like if you're not and you're private, they won't, right?
What kind of terms are you getting? Like,
well, I'd say, private credit's more expensive than a traditional bank, but in a private equity setting, interest is an add back, and we're a positive cash flow business that's profitable. So it's, I would say this, and, it doesn't really matter what the interest is you're paying because it's not how they measure EBIT for valuation. Whether I paid 6% or 8%, I don't have a cash flow problem. I don't have but it ends up being the same net income either way because it's an add back.
I'll tell you, bootstrap, it's 16% interest only. And then, to buy it down to like 12, 13, you're giving up a lot of warrants.
Well, that was our first round. We did a mezz deal with mezz debt at, in the 12 plus range, plus equity and preferred returns. But I think it gets better as you go along.
We get the right investors.
We were, with banks at, 150 over LIBOR and all that. But it's like if you want to keep acquiring things, the math is great. You can pay more in interest to go do accretive deals that create value.
Your first investor was a minority or majority recap?
Minority.
Yeah,
first deal was a minority deal.
That's what I was thinking. Do minority, sort of get comfortable with it.
Yeah.
What does it end up being? Like 30% that you?
It was 30%.
Okay.
Yeah, and I ended up buying out a partner. I had a 50-50 partner who didn't want to go down the road of bringing on capital, and I was getting bored. And it was kind of like, I don't want to just keep this business as a lifestyle business. I want to go raise capital, and he didn't want to. And so, the first investor said, we'll buy him out. And I said, that's great, so.
So when you bring in this capital, it's sort of, here's a percentage allocated as primary capital to grow the business, and then here's secondary, where some of that secondary is to buy out the partner. And then if you wanted to take some off, you would take some off.
And I didn't take any off on the first deal. Second deal certainly did.
Okay.
Yeah, so then I started to dilute myself. So, I went from a, 2/3 owner up to the first deal to I'm probably down to 8%. I'm down to now, but it's also that percent is of a lot bigger number. So to me, dilution is not dilution if you're creating more dollar value, which,
have confidence in what you're going to execute.
Yeah. So I know it's important to hold on to equity, but at the same time, and I look back, when we took our company public, the first company, the 3 partners, or 2 other partners and myself, we owned 51% of the company. But we never diluted to buy anything. Like I look back, like I should have bought. I mean, we had public company currency. We were a publicly traded company. I could have bought a bunch of companies with stock. We could have gone a lot faster. We didn't do that in my first business. I was, maybe didn't understand how to drive that. And I think, you brought up having private equity as a partner can be helpful. They are helpful. I tell people if I wanted to screw up this business, I couldn't because they wouldn't let me. I have a good board. They're smart. They keep an eye on things, and and certainly we're all aligned. So to me, having a private equity partner to help you keep an eye on things is a blessing for an entrepreneur. Because at the end of the day, you're creating value, and you're going to create a business that sells for a significant, generational wealth-changing kind of an event. So why not have oversight? These are smart folks who know how to create value. So that's how I always looked at it. Is like I'm going to keep diluting myself, but as long as I'm creating enterprise value that's meaningful to me, it's, that's what it is.
Turn a cheek on, PE. Like I said, there is good investors out there.
Yeah, there are.
There's some bad ones.
No, I've had great experiences. And it's finding the right ones who you align with that, you build a good relationship with. And it's no different than, like you talked about buying a company. You need a relationship. You need to invest time, where it's not just, quarterly reviews of numbers where they know you.
Any other tips on wealth preservation? Anything I need to,
Yeah, move to Florida before a transaction.
Move to Florida before a transaction.
Yeah.
What, 6 months ahead or?
Yeah, I don't know that New York or Chicago will buy into that.
I'll ask the CPA.
Ask your CPA.
Move to Florida before doing the deal. Anything to negotiate dual stocks, like where, or dual asset classes? What, any other things like I want to sort of make sure I negotiate that I don't get taken over?
No, I don't know if I've kept it pretty simple. In terms of, what I've done and, again, just try to build a personal estate that's diversified and be tax efficient and, things that I do. So, nothing exotic. I've stayed away from anything the IRS would want to question me about. So I keep it simple.
Well, a good P firm will take care of you. It seems like they won't really take you to the rails.
Yeah, for sure.
Larry, what's the craziest thing you've seen in M&A?
There's certainly deals that we've been involved in. You find out things afterwards with, behaviors, relationships, things you didn't know. There's always things there that sometimes you have to clean up and do. Probably not that crazy, but I think we've had some deals that, one, we bought a business in the interim space that was a really good business. It was a larger one, and we made an offer. And the owners literally thought they were worth like a tech company, like one of your companies, and it wasn't. It was worth, and the valuation was like off by 70%. It was a great business, and these were founders that were like 80 years old, but they had an annuity business in the higher ed space, and they just had a completely unrealistic view of what the value of their business was. And it was just like, wow, we went down all this road, and they came back with just like crazy demand. So like to me, we ended up 15 months later closing the deal at a reasonable number. But sometimes the reactions you get on valuation can be a little bit crazy. We haven't had. I think in general, the founders have been, and they haven't done things that I think are noteworthy in terms of stories of craziness. But
how do you present your offers? Are you doing it in person? Like, hey, this is where we're at,
or
do you sort of send it? Wait, I remember back in the day, you send a fax and then you wait for a response.
Because we have a lot. We do a lot of these, and I know that only 1 out of 3 offers is going to move ahead anyway because of unrealistic expectations a lot of times. So, we do it usually in a Zoom meeting with a PowerPoint with a full built out 12, 14-page presentation. We don't send it ahead of time. We walk through, why we love your business, what the deal hypothesis is, what we see the business being under our framework. Here's how we structure the deal. We show them all the scenarios of what the total value would be with our stock if our stock goes up, because I think, again, total return is we model out, like if we get a 2, 3, 4, 5x return on the stock piece, this is your net number. And then we'll, again, reiterate our growth strategy to them, why that has a realistic chance of happening, and walk them through a whole storyboard. So it's a pretty well thought out, 45-hour presentation, and that precedes any letter of intent.
45 minutes.
Yeah, 45 minutes. 45 minutes.
That's a log.
45 hour. That would be no. We don't have patience for that. But no. But so it's selling them on the vision, getting their buy-in. Then there'll be some back and forth, and then it leads to letter of intent from there. So, but it's our world. We're selling the good deals. It's we want them. We're trying to grow. It's not picking. And we always say that about like recruiting top talent. You're not just picking top talent. You got to recruit them to join your team. Good acquisitions, it's the same thing. You've got to convince them to be part of what you're doing. And so I think some people make the mistake and treat it like, like you said, if you're just doing diligence, it's a financial transaction, you'll get a financial seller is all you're going to get. We're convincing people that probably wouldn't want to, or maybe aren't sure what they want to do it now with us because we're the best option.
It's a journey.
Yeah. Yeah, but it's fun. It's I appreciate the where you guys operate, because it's probably 40% of my day is in M&A deal structure negotiation. It's a constant, and every deal is different, and every structure is different, and every owner, buyer, seller is different. So it's a whole lot of fun. So.
Larry, thank you so much for taking the time to have this conversation. You've helped me become a better M&A scientist.
Yeah, well, I appreciate the time. It's great to brainstorm and talk about things going on and getting deals done. So good luck to you in your endeavors, and appreciate the time and interest in what we've been doing.
Fellow M&A scientists, if you listen this far, you're right there with me. I'm hoping you find this content valuable. I love to hear from you. If you do find it valuable, reach out to me on LinkedIn, like getting feedback and connecting with folks that actually have the patience to listen to this long form content and ideas. If you got some other topic ideas, things I'm missing out here, and criticism, I welcome it. I'll take it. That's how I get better at doing this. Till next time, here's to the deal.